Well, good afternoon. This is officially the graveyard panel before everyone has to go off to lunch, so we'll try and keep it moving. There's been a huge amount of content, I think, over today and yesterday. So what we're trying to do here, this is the cash investor panel, is try to respond a little bit to a lot of the content, particularly on regulatory impact it might have on the cash investing side. So Mark's kindly introduced the panel. I think we've got a very interesting panel today with a different aspect perhaps than maybe we've heard so far. In terms of the panel, I think the big lead into this was the previous panel, which Axel led. I thought was fantastic. I think there's some good food for thought and content on that. And actually, I might, if you'll oblige, if Axel, if you don't mind, would you join our panel as well? Because I think there was a lot of interlinkage between your panel and this panel. So is that okay for you? Always prepared. And there's an extra seat, perfect. So in terms of, there's a lot of ground to cover, so I won't dwell too much on setting the scene. I think it's been well set by the previous panels, but very much, one thing I will say, there is a cocktail of liquidity risk, capital, balance sheet. All these items are coming together in a regulatory, as I said, cocktail, which is impacting the way banks have to fund themselves and also very much impacting the businesses of cash investors who are on the other side to that. So in terms of looking at not just the regulation, but the practical impact of it, what it means for cash investors, what it might mean in terms of practical transactions or trades in the market, I think from my side, that's a more interesting thing to feel where that might be going as a new horizon for investment, not just talking about the technicalities which have been fantastically covered already. So with that, I might just crack on through. We've got 4 questions here, which we'll try and get through before the time police come along. But first one is looking for alpha in a benign interest rate environment. We actually drafted this question before they actually cut rates. So in some cases, negative rate environment. I mean, it is difficult. It makes it extremely difficult. And I think the panelists have some good views on this. B, I might throw to you first if that's okay. What do you think?
I guess at this point in the cycle, and given sort of just how compressed rates and spreads are, the temptation to sort of eke out extra income is huge. I would say, and particularly huge this time around. And thanks to the ECB for the negative rate, that makes it even more challenging.
Sure.
So there's really sort of what you do as a portfolio manager is either extend in duration or you drop in credit quality. And I think both of those are kind of fraught with risks right now, certainly from my perspective. The other aspect that you need to throw in there, which was sort of very heavily covered in the panel before us, was what's happening to the structure of the money markets themselves, given the backdrop of regulatory change. It was referenced before, the banks are trying to term their funding out longer, money funds are being encouraged to sort of shorten up, and there's a technical maturity mismatch being created in the money market curve and an inflection point. So if you're not a money fund and you're not rated, then you should be looking to take advantage of that because there's natural value in that part of the curve, I would suggest. The other thing that the regulation is clearly doing, and which is probably a challenge more for a money market manager like myself, it's creating secondary market illiquidity. And that's because the dealer balance sheets are sort of shrinking, the rates businesses are being exited, as are lots of other businesses, and there's a much less inventory around. In fact, somebody calculated probably something like 75% less than there has been. So in order to get a credit trade on, from my perspective, I would suggest that your conviction has to be hugely high right now, because to exit that trade in the event that it's going against you is going to be hugely to your cost. So those are the types of things that we're thinking about right now.
Okay, in terms of a different aspect then, Richard, on your side as at a bank, but I guess primarily now as also cash investing as well from your side. I mean, how do some of these things impact you in the way you're looking to generate more alpha in your returns?
So yeah, the challenge is where's the return the GC business doesn't really give it to you at the moment, hasn't done for some time, and arguably is going to get worse. There's a whole host of reasons why that is, and obviously the previous panel covered quite a few. I think you can go out the curve, both in terms of term and in terms of credit, what collateral do you want to take. I think people are doing those. People will continue to try and exploit that where possible. I think the thing for us, which probably is the biggest driver at the moment is effectively looking at different structures. So you can go out the term in a repo, that's great. You can go out the term, widen your collateral profile, that's great. But really chatting to people and trying to work out what they want, because it's very easy to look at everyone and say everyone faces the same challenge, which at a high level they do. But you get a little bit below that, and it's quite nuanced. So one firm will have, say that their focus will be, keep it simple, sheets, and sheet will take preference over, say, liquidity. Another firm will have, there'll be an RWA element blended into that they'll be concerned about. So it's really trying to tailor the trade to the individual. And I think that for us is we've all spoken about shrinking balance sheets. We don't have the resources internally to do the trades. It's not yields come off by half. We can't double our sort of cash repo book to accommodate that. We just don't have the balance sheet. If anything, the balance sheet's getting shrunk, and that's the same across the board. So it's really then trying to move into those other trades where, to the same extent, the same as Carl was mentioning earlier, where you're getting the transactions on the sort of low return business is kind of coming off the book and it's being replaced with those high yielding transactions.
So it's more the bespoking of trades. You're finding that's the way to actually generate that return you're
Absolutely.
looking for.
But I think the key thing there is it's not consistent across. You don't face 10 counterparties, and for us the high yielding trade with each of those counterparties is the same one.
They're all different.
It's very much dependent on what those guys are focused on.
I think that's interesting. That actually will lead us well into the next point we'll come to. So Gareth, your perspective, I guess, is a little bit different. I think that's why it was useful to have you on this panel, in the sense that I guess you're, obviously a liquidity, generally, net a liquidity borrower, I guess, from the market. I mean, in terms of the constraints you're hearing from the investor side in terms of lack of supply and not being able to do just basic generic GC trades anymore. I mean, from your side, I mean, what do you think investors should be looking at in terms of that? Is what, like Richard said, in terms of more bespoking trades, or is it going to be more balance sheet related, or is it going to be more liquidity ratio related? What do you think?
I think everyone's kind of touched on sort of the constraints we all sort of face, but maybe quickly reiterating them. I mean, yes, we do have sort of obviously a need to sort of extend the duration of the funding. I think per Richard's point, the straightforward its LCR compliance, sort of so forth, is becoming more nuanced in terms of understanding sort of just exactly where liquidity needs arise in particular structures and particular sort of areas of the organisation. So there we do have some degree of, I guess, nuanced matching. I think what we are seeing is that counterparts are probably more willing to consider all sorts of delivery mechanisms to actually sort of provide the financing to us, in that regard. I think there's probably a couple of things that, clearly if I were to have looked through what we had in the box, say Monday morning before heading out to finance, there will be, I guess, sort of the emerging market assets which have their challenges attached to them. Credit quality is one thing, but also I think sort of in, one of the audience posed the questions in terms of sort of, the actual sort of mobilization. So, whilst you may reference sort of, Brazilian equities, for instance, which may get some people recoiling with horror, but I think, you do look at sort of a market which has, inherent sort of liquidity, you have sort of daily pricing and so forth, and then it becomes, a discussion in terms of how an asset like that can actually sort of be brought to market. And Brazil probably isn't the best example in terms of sort of pledge-based financing structure, but nevertheless it can be sort of structured in sort of TRS format where if the counterparty is able to do that they could actually sort of hold the physical immunize themselves against all market risk and so forth. So I think that there are things that we collectively can look at.
So when you talk about mechanisms, you're saying it's not just a standard fixed income or equity sort of GC tri-party kind of trades. You're talking about whether it be upgrade, downgrade trades, swaps, all different types of mechanisms, and maybe looking at that across maybe some of the not so mainstream markets as we've had in the past.
I agree. I think everyone, for one reason or other, has some degree of constraint, whether that's the money market funds and sort of so forth. And I think you can argue about sort of, whether that's right, wrong, and I think you have to accept that sort of we are where we are for a whole slew of, reasons which, we can discuss and debate. But, I think, they've all been probably taken, those decisions, with, the right intentions. And I think it's just a question of adapting, all of these things. Now whether it's sort of, come the money market funds being somewhat constrained in terms of, short-dated sort of, G7 sort of, collateral, my view is that, that's something we just have to accept. And then it's a question of sort of, continuing with, what we have to finance, looking through Monday morning's box. It becomes taking that, do we swap that then sort of for G7 govies? Does that give us the opportunity to put that out for sort of G7 govies? And I think, every cash investor is going to be sort of, somewhat constrained, in that regard. The investment in terms of sort of, that govie, is it a question of, that cash then is deployed to buy the govie? They understand that sort of it's going to be held, 3, 6, 9 months, 12 months, 2 years. They can swap that sort of, and upgrade it and then provide us with. So I think
great
from our
element of
perspective,
creativity.
so I think you just have to accept that sort of that's where we are. And I suppose the other point, before sort of hogging too much time, is that fundamentally, we are talking about a product here that is relatively low risk. And I think providing that sort of you have some degree of sort of diversification in sort of the collateral mix, and it's not one shape of liquid ABS or something like that. That the products we are talking about are daily margins, sort of typically have haircuts and a diverse collateral pools.
Indeed.
And the counterparts that traditionally in the space are reasonably highly rated. So I guess that's my.
No, that's a well-made point. Saxel, so as a cash investor yourself, obviously, you in the previous panel gave us some great colour on that. How do you, in terms of looking for alpha in your portfolio and the opportunities you see, how are things changing, or how do you anticipate things changing for you, and how you deploy your cash?
In the sense that the biggest problem we're starting to see is that finally, after years of talking about it, actually the counterparties, i.e. the banks that were sort of lending our cash to, are starting to change, let's say, the willingness as to what is the willing to accept. So I think that's actually becoming quite a challenge, because for us, one of the biggest lessons that we learned in the crisis, liquidity is only there when it's a legal maturity. Yeah, because people on a legal contracts, the market has no legal contract with anybody.
Right.
Now, then the question becomes, so how do you then replace it? If I start to term out everything, am I then still fulfilling my liquidity function in a sufficient manner? And therefore, in terms of alpha, the only thing what we did in terms of alpha, we completely changed, let's call it, the currency structure of the balance sheet, where all short-term liquidity became dollar-based, and dollar-based because of, let's call it, the FX swap market dislocation, actually still allows us to generate, let's say, very much LIBOR plus types of returns. But other than that, let's say, do I really want to start to extend structurally my own term structure? I'm not so sure.
That's interesting. You've had a focused approach to actually change the currency structure of your investment pool in response to that. Interesting. But that leads a little bit well into we've got a couple of questions. If we can have the first one up for this panel, please. Basically, this is taking a little bit on what some of the previous panelists talked about, and specifically, I think Mike Manor mentioned yesterday, if the people who were here for that panel, said that he was talking to, I think he said an Asian client, and he said to the Asian client, why don't you take equities back as collateral on this? And they said, well, we don't do it. And he said, what would make you do it? Enough basis points? And the client said yes. And he said, how many? And those guys said, well, we're doing stuff with you at 15, it should be 40 or 45. So now we're saying 25, 30 basis points to, for lack of a better term, get him out of bed to be interested in looking at something which is more risky and outside his current profile. So we thought we'd ask the audience that very question, which is to basically say, what would it take for you, not a small change, but incremental change in your criteria, a significant change in your criteria, take some more risk, whether it be collateral or going out the curve, to get you to change your investment criteria. So be interested to see the result. Vote now, I guess. Interesting. Well, it takes a lot to get people out of bed in this audience, I tell you. So we can see the results there, but that's 50%, 25 basis points more. Okay, well, I think that's an interesting reflection. Probably slightly higher than we anticipated, but it's good. What do you think? And in talking to people Richard, in your experience, in terms of people going out the collateral curve or extending in term? We've had a lot of talk about that already today. Do you really think it's a matter of a price adjustment, that there's a price adjustment that will bring clients and people in this room into the market?
Yeah, I do think so. I think, it feeds back into my sort of comment earlier about the bespoking of transactions. If you look at widening the collateral profile, widening what people will take, I think to a certain extent, that's already happened over the last couple of years. I'm not going to say that within the equity world every asset's financeable, because it's not, and I'll be shot down for saying that. But certainly you've kind of got to the point where you were perhaps 2007, 2008, where you could pretty much fund most assets in your box, with the exception of, say, some of the Asian assets where you have a specific legal or regulatory challenge to actually getting that asset deployed. So I think that's one sort of area that people are still looking at and still trying to work on. So there's definitely appetite to expand collateral schedules. I think people still willing to engage in that conversation with you. I think for us the challenge is what we can offer. Most people can finance those assets anyway. It's moved on from that, I would say, to a certain extent.
But from your own perspective over the last couple of years, in response to the first question, looking for alpha and the movement of the market, would you say you're doing longer trades and also looking at a broader array of collateral?
Yeah,
would you say both?
I would say both. I would say you can't. There are certain transactions where people want the long funding for GC assets, but by and large, people want to keep their options open. They want to have as broad a range as collateral for as long
it's not either or in your perspective. It's sort of both.
No, like I said, there's definitely situations where it is either or, but I would say generally it's kind of people want that flexibility where they can put assets in, and especially if you talk about how, to Gareth's point earlier about how you deploy assets, you've got, I think. That's relatively well sewed up now. If you look at the tri-party agents, these things work very well. They're very efficient in the most part. The thing we are seeing more and more of now is kind of, I guess, I was thinking about how to explain it, and I'm kind of struggling, but probably sort of legal document intermediation is probably the best way to look at it, where there are certain guys out there now who you may like someone's credit, you may like the trade you want to, they're offering, you may like what you can do, but you just don't like their documentation. Right, so you've got, if you look at Japan, for example, you've got some guys who've got a very bespoke sort of documentation. Now, we like the credit, they like our credit, we like the collateral they're willing to give us.
Commercially, it works.
Yeah, but it's then how do you reconcile yourself to that piece of documentation? So we're seeing more guys move into that space now where they're willing to take that kind of legal risk, if you want to call it that.
That's another interesting dimension. What do you think from your business side, B? Is it both, or is it one than the other? You're a bit more.
I'm kind of caught a little bit.
Style's a bit more cramped.
Yeah, very cramped. I can't swap my portfolio, which I'd like to. I'd do the whole Euro portfolio right now. But so from a broadening collateral perspective, I mean, repo for a money fund is typically an overnight cash management tool. So right now it's trading negative in euros. As a house at BlackRock, I think we take the view that if you've got a good credit process and you've got a good screening process, then really you should take as wide a collateral set as you can, especially if that adds basis points to what you can get off the back of it. So I'm all for it. Having said that, I haven't done it yet. Right. And a little bit of that is because the client base hasn't been used to hearing about it. So in the US, I know that money funds do it. In Europe, I don't think it's that prolific yet, but I think the trend is going there, definitely. The one caveat I would say is that if you're a rated money fund, you can only put 5% of non-traditional term repo in your fund.
But I guess that's one of the trends we've seen, particularly in the US, I guess, in the money fund sector, is there's been a big growth in the segregated accounts or separately managed accounts area of big firms like yourselves because of the straitjacket kind of restrictions on investing. I mean, do you see those kind of separately managed accounts, there's more opportunities there perhaps?
Absolutely.
More flexibility?
Yeah, more flexibility to look at sort of more structured product and generally just to sort of tailor the risk of the portfolio to what the client really wants. And also for us to guide those clients, to take them to the spots in the market that aren't being sort of met with supply. No, okay. Gareth, then, on your side with this, in terms of what you're seeing, I guess you ask your perspective of what you're seeing from your other side, your other counterparties. Are you genuinely seeing people going longer in trades and also being more creative or more diverse in terms of the collateral? Is that an ongoing trend, or is it more one than the other from where you sit?
I wouldn't say there's a particular trend. I mean, I think you clearly have sort of a population of counterparts that either legally are constrained or from a familiarity perspective are, you know.
So their envelope is their envelope.
Yeah,
That's it.
and then there are other counterparts that, you know, they're happy to sort of basically have the discussion in terms of, you know, show us what you have, and we'll basically we'll see if we can sort of do that. So I think, it's varied. Certainly there are counterparts that I think Kabir's point, get it that, there is an opportunity there based on the sort of the current benign rate environment to, go out longer term, take, harder to finance assets. But if you were to sort of call up and sort of you had $5 billion to go on a Monday morning, you would struggle to,
Right.
I think to sort of lose that in the space of a couple of hours if you were talking about sort of long-term, alternative
It takes
sort
much
of.
longer to.
So I think
organise
it tends to be sort of more bespoke, and I think a lot of this is also just an opportunity to some degree to actually have engaged conversations with your customers in terms of what it is they're after, where the sort of the natural sort of sweet spot is, and I think with a lot of this, if you can
It goes to
get
Richard's
it
point.
right, just actually use it to solidify a relationship you have with
Yeah,
the
it goes to
counterpart.
Richard's point about having things be more bespoke, I guess. So Axel, so how many? That's probably an unfair question. How many basis points to get you out of bed, or more realistically, in terms of your evolution of your portfolio? You mentioned currencies, but in terms of your repo activity or your tenor, is that something that's factoring in for you in terms of trying to?
I think, let's say,
Generate?
we'll probably have to start to work on basically effectively just building a tenor ladder. I don't think we'll ever go into evergreen structures, because at the end of the day, I'm going to be having to cough up cash when all of you are short of it. So I'm not going to rely on you bringing it back if you legally can't or don't have to. And therefore, for me, we'll need to change our behavior, but it's actually, I think it's difficult to find. The only sort of philosophical question that also we're partly saying, are there other more natural counterparties than banks when you're talking about the short term, the real short term space?
I think the answer must be yes.
Yes,
And
yeah.
that's-
But how can we, generating that sort of infrastructure is actually...
I think that's, we're not going to do it overnight, but I think that has to be sort of, evolution. I think in terms of regulatory oversight, clearly there will be some, given the concern on, all of this liquidity disappearing into sort of, shadow banking or unregulated sort of vehicles. But I think, like all of this, it's, it's the only way that things can evolve. And I think the other panelists touched on it in terms of sort of, short-term cash being depoted with banks to a large extent is worthless, in that all ends up happening is that the yield is, zero or negative. It all gets deposited with the central banks, and it clogs up banks' balance sheets. And you can talk about, that transactional banking kind of relationship, should that even be treated as off-balance sheet as far as the banks are concerned, because you start almost as a bank being unable to actually offer core banking services to people. So there's a lot you can go down if you want to go down that route.
No, you go quite literally. One, I know, just conscious of time here, just one quick question on this subject, and we'll move on to the next one, is that we're talking, topic here, more alpha, what extra basis points does it take you to look at something different to what you're doing today in your investment mandate? If we talked about rate cuts and negative rates with euros, now, if we're looking at somewhere like the UK, where there's a good chance perhaps of a rate hike at some point in the near future, with rates with actual not zero in front of them, ones or twos perhaps in the future, do you think this debate goes away? I mean, in the sense that if a cash investor can get, in terms of a real nominal return, the extra 5 or 10 or 15 as a spread basis is something that won't be discussed anymore, or do you think that this is just a trend which is going to continue? People will be stretching for those extra basis points. So, do you think higher rates make a difference to this debate or not, Rich?
No, I'm leaning towards no. I think it's more a question of liquidity and excess liquidity, and how excess liquidity and the right kind of liquidity. I think that's what's driving it. I think rates will have an impact, but I don't think it will be that pronounced.
What do you think, Gareth? In terms of, would higher rates make a difference for people's ideas of relative value going out the curve or collateral?
I think optically they will, but the reality, we talk about negative interest rates, and if you're in close to zero, inflation, then if you put it into real terms, it shouldn't. But I think optically yeah. People just think of that, and you go back and look at 5-10 year sort of government bond yields in a lot of countries, and I mean, what's Switzerland at the moment? 80 basis points for sort of 5-10 years, and if you pay them 25 basis points, you're talking about percentage terms considerable uptick, particularly if you go back to pension funds holding assets, etc., ditto JGBs and so forth. So probably, but I think it's the optics more than anything else. But, so.
B, what do you think?
I think, does it go away? I don't think it goes away in its entirety. I think obviously the higher rates helps, but from my perspective, I think I'm still going to be worried about secondary market liquidity in itself and where that is. And I've put myself and all money funds have put themselves in this space where they're offering daily puts. Yeah. So unless we change that model.
And that doesn't necessarily get better if rates rise, right?
Right.
Okay.
Right.
What do you think, Axel?
Well, mathematically, it will make a difference in the sense, in a way, you should be asking for more the higher the rates become, just to be mathematically equivalent. In a zero-rate environment, to ask for 25 basis points is asking for the sky.
Yes. Yeah. No, very much so. Okay, we might just, in the interest of time, to move on to, which I think neatly goes into the next topic. If we have the next question up, it's been, I guess, we've had a lot of talk about new structures, moving in different styles of trades, and evergreen funding or constant maturity funding, whatever you want to call it, has been de jour for the conferences I've been to for some time. It's discussed very widely at this conference as well. I mean, I wouldn't say this is an emerging trade. I mean, it's already a big part of the market, right? So, but then in talking to people, you know, a lot of the, what appears to be, I've got no science on this, a lot of the activity that goes on in terms of this evergreen type 33, 35 day funding tends to be a lot of it's interbank, a lot of between banks, and we were quite curious as a panel to get the view of the audience of how many people are really participating in these kind of, you know, 33, 35 day evergreen structures. Hopefully it's a lot of yes, but also obviously there's some choices as to why maybe no. So if you'd all vote, that would be great. This will be interesting. 67% yes, okay, so, and a mixture of the others because of systems, everything else. Okay, that's probably a little bit higher than probably anticipated. We've got a very sophisticated audience in today, I guess. In your business, B, I mean, you know, is this evergreen? Is this part of your business, what you do in terms of managing your portfolio?
Not yet, but I can imagine that it might become that. I mean, at the moment, I think where we're playing a role with structured sort of credit as a sort of an asset class is probably with callable and puttable MTNs. We're also using collateralized CP, which is in itself structured in a sense. Again, and I'm going to sound like a broken record, for me that challenge about sort of keeping some aspect of liquidity in these structures is sort of front and center. Right. And it's because of the structure my money fund has itself. So I can't put 50% of my portfolio into these structures. It takes away my liquidity. But the other thing that I would say is that the banks that issue these structures, I think for money funds in particular, are going to be hugely concerned whether they retain their A1P1. So right now, the very topical sort of story around sovereign uplift removal in senior bank ratings is a huge factor for how engaged we can become in these structures, because any move to an A2, P2 for a rated fund kind of takes the value out of
that
this.
applies with a counterparty or an issuer, it's the same.
Right.
It's the same for you. No, I mean, no, without a shadow of a doubt. Rich, in terms of, I mean, evolution of sort of evergreen or constant maturity financing in your business, is that?
It's very standard now. It's you don't want to say it's the new overnight, but it's pretty much, I wouldn't say it makes up all of the book, but it's certainly a significant proportion. People want it because it does exactly what they need. They don't want that, we talk about term, but it's about having the right term and having that constant term as well. So if you go and do a 1 year bullet, that's great for, if we look at LCR, that's great for 30 odd days. That's great for the majority of the trade, but then you'll get a period of time where it's good for nothing.
Yeah,
so
sure.
The same with that. You get that trade on, that trade will continuously give you what you want until such a point when it's called. So yeah, we don't see, for us, and I can only speak for what we see, but the term business is, we do very little term. It's all an evergreen or an extendable or some variation of that.
You think it's taken away a little bit from trades that would otherwise have been 3 month?
Trades
has taken away a little bit from that as well, right? Yeah.
I think one thing to add, it kind of, people talk right now about the market being quiet and things being subdued. I think the same balance of businesses out there, for us, it's just a lot easier to manage because you have these transactions on and you're not getting that call, sort of 10, 15 calls a day where you're looking to roll every overnight deal or every sort of 1 week, 1 month, or whatever trade. These things just sit there. So in terms of, I think they're very much the standard now.
On your side there, Gareth, would you mirror that? Would you say that, if you compare now to maybe a couple of years ago, the number of your counterparties and clients who would engage in a constant maturity or evergreen trade is grown drastically over the last couple of years?
I wouldn't say grown drastically, to be honest. It's kind of been there, and I think sort of we've probably got more term on bullet, and I think just obviously per the slide, there are obviously clearly some who preferred that, and that becomes the challenge just in terms of managing sort of the roll down, and I think sort of Beer touched on sort of that previously, that sort of that there are I think embedded sort of puttable options as well in that, so that sort of once the value has basically been extracted, unless you can renew it puts. So literally you've got your whatever your benchmark is, whether it's 60 or 90 days in terms of sort of what you need, or sort of 30 that come to the expiration of 11 months, for instance. If you haven't renewed it, it's gone. So you've not lost that 30 days. I mean, it just puts another component into it. And I think it just is another piece, just in terms of discussion with counterparts, as what they can do, and ultimately, our collective end goals. So.
Do you find there are still counterparties of yours out there who just say they can't do it because it's outside their mandate, or they can't book it, or they can't?
Yes.
There's still that.
Yeah.
So maybe the slide's gone, but apparently we have a much more sophisticated audience in here, and obviously.
But I wouldn't sort of. I mean, clearly there are, and I think it's just. My point is, you just need to be sort of engaged with the counterparts as to what they can do and what people want. I think that's what it comes down to.
I mean, it was a great point, I thought, before, actually said you can't trust the market for liquidity. I mean, is there a place in your portfolio for, constant maturity, or these trades, evergreen trades, or CP trades, as B said, with puts in them, so you could actually manage to a put date rather than just manage to legal final? Do you do that now? Is that something that's going to be, if not useful for you in the future?
In the sense that I think we've looked at it, and we've always discounted it, and partially because we always had another alternative that basically just gave us everything we wanted anyway. The only question I sort of have, let's say, maybe to the other panels, what happened to the ARS market in the US?
The what, sorry?
The ARS, the auction rate securities market, the so-called solution to the maturity transformation. I'll just leave it out there.
Exactly. So, okay, well, thanks. So we're running, coming up to the end of our time. I might just throw, not that controversial, I think, one last question to everybody, and just get a quick opinion from everybody, and we'll wrap this up. So this question was with regards to corporates. On the back of, there was a very instructive panel at a previous conference held by Euroclear in Brussels, where they had 5 corporate treasurers from GE, Whirlpool, Turkcell, Nokia and Microsoft on a panel talking about their interaction getting involved in the repo market. And I thought that was great, having 5 corporate treasurers sit there. I guess they're where they are, and they're moving along. Wasn't quite as dynamic as maybe you'd anticipated on the panel, overnight de-risking books, doing overnight Bund repo kind of thing. So it was quite interesting to hear them speak and hear market practitioners particularly speak about it. So we thought we'd throw a question out there, which is that, are corporates the saviour, I guess? Are corporates going to be the saviour, I guess, of the securities finance market, or, let's say, other alternative financing entities, insurers, Japanese banks, or these other things? Please vote. Well, there we go. No 58%. Now what do we talk about? No 58%. Yes, 16% maybe. I think that's interesting. I mean, maybe this, I think, from my personal view, is a bit reflective of the fact that, all the things we've talked about today, extending maturity, collateral curves, new trade structures, these kind of things. I mean, corporates coming into the market, or other types, are often coming in for overnight bonds to lend their dollars for a day, which is a perfectly fine trade for them, and I understand why they do it. But in terms of the tapestry of bank balance sheets and what people need to do, is not really additive to the current regulatory environment. So I should ask the panelists, what do you think in terms of alternative liquidity providers coming into the market? Is that including corporates, is that the saviour of the market, or not, or it's just another piece of it?
Yeah, I think you've got to make a distinction between, say, if you're talking about corporate treasury departments, I think no. I think they're they're fairly active in the government repo space at the moment. They're not really active in the sort of like within the fixed income world, the asset backed or the credit side. You translate that to the equity world. We know there's a handful of guys out there who will do equity repo. But over and above that, people always talk about it, but it never really materialises.
So it's a piece of the puzzle more than that.
And even if it does materialise, is it, back to the earlier point, is it offering you what you want? If you've got a new guy, a new liquidity provider there, it may be that it's a non-bank, so you get some benefit from that. But if he's offering you sort of overnight 1 week, it means nothing. Yeah. I think if you look at other other non-traditional cash providers, I think they offer benefit. I think there's a lot of guys coming out of the woodwork now who are either, do you mean they weren't interested before because there were other things they could do that gave them a better return.
Pension funds,
REITs, that kind of thing. I think where the institution you work for has a long-established relationship with a firm, and maybe corporates fall into that as well. Right. I think there's some sort of bespoke type transactions there that have value. But I would say on the corporate treasury side, what's their mandate? Their mandate's conservative by nature, so no, I don't think it adds too much value.
Gareth?
I don't think there's too much more to add on that one. I think it's just an additional sort of source, and that's probably it, to be honest.
Bea, what do you think?
I agree with the results. I mean, our corporate clients are basically just doing overnight, and it's generally high quality collateral. If they're doing term, it's no longer than 3 months. That's what we're hearing. Yep. Some of our FI sort of channel clients are probably looking more at doing non-traditional repo, and they're really using it as a way to sort of sidestep the threat of FNAV to money funds, because they can book it a pop. So it's interesting.
Well, in a sense, it's still, for me, it's an open question. I think corporate treasurers, if you're looking for a constant source of liquidity, don't look at the corporate sector. Ultimately, that's where the banking system was designed to provide that.
We know for a while we have corporate investors who, when it comes to pay a dividend, they say we've got no money anymore. So absolutely right then. Thank you to the panel. Just to quickly wrap up, I've got three points. So I made notes here to take on this in terms of looking for alpha, in terms of investors. I think it's pretty clear. Investors want to generate more alpha in their portfolios. They have to follow the regs. And in that sense, deliver trades that people like Gareth need in their portfolios. And if you don't move to that in one aspect or another, then it's going to be very hard to generate more alpha in your books. And I think whilst the regs themselves are technical, I think where they go and the behaviour of banks and the kinds of trades they need is going to very much lead the thought on this. That leads to a lot of what other panellists have said in terms of more flexibility, creativity and bespoking in your portfolio management to be able to achieve what you want to achieve. More over than the more vanilla kind of investing where you could just invest in GC quite simply across a range of counterparties. And importantly, I think cash, although it's been knocked down a bit in the last few panels, is an important asset class. It's still an asset class which is part of all wider portfolios. Investment managers who specialise in cash will have to find ways to invest it, and I think hopefully we've heard from this panel we will try to find a way. So I'd like to thank the panellists, and I hope everyone found that moderately interesting.
Thank you very much.